All right. Today I'm talking with Rohit Krishnan, who has a wide-ranging background. He's worked in consulting, invested professionally in both public markets and startups, and writes one of the very best subsects out there at Strange Loop Canon. So Rohit, welcome.
Thank you very much. Pleasure to be here.
So first question, David Graeber has a book called Bullshit Jobs, and the thesis is basically that many jobs in contemporary industry are sort of pointless and meaningless and aren't really even valuable to society or the employees themselves. You mentioned Graeber's work in actually quite a few of your essays. Do you agree with his thesis?
I like Graeber's work. I should say that up front. I liked his book, Debt, most of all. I liked, obviously, Bullshit Jobs as a thesis that he put through. And on reflection, I think I disagree with his thesis per se, that most of it is basically bullshit jobs for a certain value of bullshit. I think it gets at something interesting, though, which is the fact that a surprisingly large chunk of jobs that exist today don't have a direct tangible output associated with it that you can look at and be comfortable or happy with, right? Like, I mean, if you turn the clock back, I don't know, like 100 years even, you had a lot of jobs where even if you work in a factory, you make a little rivet, you see the rivet at the end of it, or your job is to polish it or to file it. There's a much more direct relation of your job to an output. I think that's gone for many, many, many jobs these days. And as a consequence, a lot of people, because they can't see the tangible output, feel like their jobs are bullshit. Now, that's not to say there is no bullshit out there, but I feel like the term as it were, explains too much. What's more likely is that there are many jobs where you feel alienation, as Marx would have put it. And as a result of it, you think it is bullshit. Like most of consulting kind of falls into this background, into this bucket, if you want. Large chunks of banking falls into this, depending on, whether you agree with much of what Matt Levine writes about. And any other middle management jobs thereof, right? I mean, the Valley is entirely filled with people claiming that whatever 80% of it, name your tech company, effectively is jobs that should not exist. Most of marketing, advertising, internal communications, HR, I mean, you name it. Any function where you're not entirely sure what the output of their work directly, tangibly impacts something, you're suddenly you kind of call that a bullshit job and shrug it off. So I think my take on it is that it gets at an interesting phenomenon, which is this thesis of alienation from the products of our output, although I mean it slightly differently to what Marx wrote about. However, it is true that as a consequence, more and more of us kind of feel disconnected from our work in the first place. There are jobs out there that I think shouldn't exist, even though you can credibly argue that in the current system, they do exist. I've been recently kind of looking into the California NIMBY movements, mostly for masochistic purposes. And I'm a large part of it is because of jobs that should not realistically exist. I mean, you don't need to have a job to do whatever, and an EPA analysis for a hill, or for a house that is being built on a hill where nobody else was living for most of the time, but they do happen. However, they happen for XYZ reasons. Now we can add another job to kind of curtail it, to kind of figure out which ones of those regulations need to be removed, etc., which in Graeber's point of view would probably be putting bullshit squared to kind of remove bullshit, as it were. However, I think his more concrete thesis that makes sense is the part where he identifies the fact that a lot of people are feeling entirely disconnected from the fruits of their labor and feel like they might as well not have done it at all. And I'm not entirely sure people are the best judges of the value of their work, even though I think intrinsically we all feel like they ought to be.
Got it. And I maybe to bring this strictly to Silicon Valley, I guess this has actually been a theme, right? Over the last year or so, a lot of companies overhired during COVID and had to sort of course correct.
Yeah.
I think one actually take that SBF is now kind of forgotten for, but that was really popular at the time was, he was going around saying FTX actually was shipping like one of the best products for traders on crypto out there with like 30 engineers or something.
Yeah.
And he was going around on like the podcast circuit and everything, talking about how he thinks all companies can sort of do this. And, maybe like getting thrown in prison and FTX being a little bit of a sham could kind of cloud that. But do you think he like had a point or he had any sort of insight there?
So he does have a point. However, I'm not entirely sure it is the same point he was making. It is true that the FTX exchange was really good, right? Like, I mean, let's kind of give it that. I don't know it well enough in the technical details to comment, but credible people who used it tell me that it is one of the best exchanges that they've used for crypto, which admittedly is not saying a whole lot, but let's give it its due, right? The interesting part, if you look sort of across the valley, is not how many people are required to build the bare bones of the service, but how many people are required to give sufficient level of user experience to the vast majority of their users. And they asymptote very fast, right? So if you sort of ask what, you like Twitter today is run with whatever 85% less employees than they had before. And you can argue whether it's sort of they're shipping or not. Like that's a separate argument, but like the site functions, right? I mean, the site is functioning sort of relatively well. Apart from sort of self-inflicted wounds, the site functions pretty well. The wounds are all like, we unplugged random servers or I'm going to take away the block. It's not, suddenly like your tweets are just not going through. Those error rates are much rarer. However, it's also a much smaller company. So you got to kind of ask yourself, like, do I want to run, I don't know, a 7,000 person company that makes $5 billion a year in revenue and like is marginally profitable? Or do I want to run like 100 person or whatever, 500 person, 600 person company, however many there are, and makes like $1.5, $2 billion in revenue and is marginally profitable? And like, it's a choice, right? I mean, given the choice, most people would rather go to become bigger because it makes sense. And in order to get bigger, every incremental effort from say 80% onwards takes exponentially more sort of, every incremental benefit requires exponentially more effort. And that's true because of a whole host of things, not just technical complexity, although that exists and does scale. Like Google could not run with like 30 people, right? Or 100 people. I don't think so. Even their search team is much larger. Their research on AI for the search team is probably that large. Because it's just a really complicated company, even though at the very fundamental level, you and I could probably create a mini Google with like 3 people. Because it's not, index a bunch of stuff and like search against it is not the hardest problem in the world, which is why we are seeing a bunch of AI startups coming up and trying to do this in the first place. However, if you want to make it performant and available across all devices, available to the entirety of humanity, does not go down, high levels of accuracy, low levels of spam across 10 different product lines, suddenly like you can see how each layer of this adds, a 10,000 more people. Now, should they be 150,000? I have no idea what the number is like, but like credibly, they can definitely trim down by like 20, 25, 30%, which is what they're all doing because now, they have cloud cover to say like, even if they did reduce in revenue, they can say like, no, it's the right thing to have done and we'll grow again later. But even if they don't reduce in revenue, they are all sort of geniuses, right? I mean, Facebook's had sort of the best few quarters because they cut a whole bunch of dead weight, which like, can you imagine the furore if Facebook were the only company to lay people off in 2021? They could have. It's just like, they couldn't get away with it. So some of it is like societal pressures. Some of it is operational efficiency, which is what SBF's point was. But some of it is also that like products that are complicated require large groups of people to actually ship it. Like SBF's product is a good product, but it was a simple product, right? It was a trading platform that focused on like, a few different things. But if he wanted to actually provide it to everybody in the US, he would need like a regulatory policy team and a product team and teams that are split between, different levels of expertise and a consumer specific team, versions that actually shipped on every single mobile platform and did not go down, and various custodian teams and backup. Like you can see how all of these things funnel out. In fact, many of the failures of FCX basically come from the fact that it had 30 people kind of running it, as opposed to saying like having a board or having a CFO or like in accounting, like the things that you would expect them to have, they don't have. And like that's why Coinbase has sort of orders of magnitude more people, right? Arguably, again, you could say like they don't need to, but Brian Armstrong doesn't strike me as the person who shies away from controversy. And he hasn't like said, oh, that's right, we can just run Coinbase here with like 30 people, because he can't, because, he probably needs 30 people just to interface with SEC on a regular basis, sort of regardless of the slapping around that he gets there. So, I feel like this is one of those like POC to production issues, or like, first few users to scaling issues. I think that the trend of trying to focus more on efficiency is good, but the answer is not to say like, oh, you only need like very few people to make something world shattering, because except for very small niches, that's just not true.
So what do you think about the impact will be with tools like Copilot and other AI productivity increasing tools? Like, one thought is it would actually make like the SBF dream become a reality, and you could just use less people. But from what you're saying, it's like, if you give a data scientist like superpowers and he can do the work of 5 data scientists, like that doesn't solve the HR and the managerial problem of sort of needing all the supporting functions. So how do you think AI will impact this?
I think it does help already, right? So if you think about the largest success stories of AI so far, they've all been surprisingly small teams, even though they've all been relatively simple products. Like OpenAI, when it shipped GPT-4, had like 200 people, give or take, which is not much, right? That's like a Series C startup otherwise. Midjourney, when it was making a couple $100 million, like, or maybe still is, had like 11 people. So there exists a way to create some value at different points of time without large teams. But if you think about sort of pre-AI, you had the same thing, right? Like Instagram was a tiny team. WhatsApp was like 50 people when they got acquired for 19 billion. So like single-threaded, small, focused products can always be built by small, focused teams. But as soon as that goes from being a single-threaded small product to like something that spans everything, you have to build out more. Like, I mean, OpenAI is already hiring like crazy they need an iOS app and an Android app, and it has to work on chat, and they have multiple versions coming out. There's an enterprise version, like, which the complexities suddenly start coming up heavily enough that like they're going to become a few 1,000-person company. Because even though they're run very simply and the core product is still GPT-4, arguably, you can still see how that comes up. It does supercharge the productivity of the individual or the small businesses, but I would think of it more as like it compresses the whole spectrum as opposed to obviating the need for any of these things to have happen. Because like if before a 10-person team could only aspire to sort of a few million in revenue in best case scenario, now they can aspire to 200 if they capture and identify a need. However, this is also, it's an incredibly competitive market because there are a lot more 10-person teams who can go and find that and capture that and go after it, which means like the Red Queen race is very, very strong. Your lead is measured in like months or years, as opposed to being measured in, years or decades, as was the case before. Like Facebook enjoyed a fairly longish period of monopoly, quasi-monopoly, however you want to phrase it, before their social dominance got sufficiently like dinged by, I don't know, TikTok, right? Snapchat tried, it was never at scale. Instagram, by the time they had like a few 100 million people, like they got bought out. So like it was, they didn't really have a competitor. OpenAI has like 2 credible competitors with like billions in funding already. Every large tech company is building one. And they have like 15 open source competitors in the span of 6 months, 9 months. I don't know. Like the speed cuts both ways is my point. So you can create larger companies with smaller teams just because that is the nature of what Copilot or any of these tools actually enable you to do, because like you could code much faster. But like, just like you, Dan, can code much faster, or me, Rohit, can code much faster, that's true of everybody. So it democratizes access, which means like the optimal size of companies probably does go down, but the whole curve shifts down, as opposed to saying like you get an unfair advantage, if that makes sense. Because it's a much more competitive market.
Yeah, yeah. Like one thing I've wondered though is it easier to go from the ground up to build a super lean organization that's like AI first than to go the reverse? So say in 5 years, the Copilot tools are substantially better than they are today.
Yeah.
And the ways to get leverage out of your engineers and data scientists and product builders is like very obvious to everyone. So
Hmm.
that's not maybe a competitive advantage. But if someone came to you and said, like, we're just going to build Slack, but we're going to do it with, a fifth or a half of the employees of Slack. And the reason that they can't compete with us is because they have so much organizational like baggage
Oh,
on them that it will be harder for them to go down to our size and build all the tooling to do this in an efficient way and, reduce workforce or whatever it takes versus us to build up and just build a copycat, but more
yeah.
efficiently. Like, would you invest in that sort of thesis?
Not really, but it's an interesting question though. It's because like if you think about Slack's biggest competitor was the arguably the company with the deepest pockets in the world, right? It was Microsoft, and plenty of people went after them to add different features, etc., etc. And in some ways, it's partially because like an exist. It's weird, right? I mean, AI companies today, because AI exists sort of as like a, I don't know, like a layer that everyone can take advantage of. It means like the biggest beneficiaries have been the larger companies with inbuilt distribution. Like Microsoft is building that into all of their products. Google's building it into all of their products. And like, there's no AI company except for OpenAI who had the first mover advantage is going to hit their, the first 1 billion users will be onboarded to AI through us. That doesn't exist because like every large tech company is already building that into their products. So at best, all of these guys are competing to become like embedded service providers, like, either specialist niche providers or embedded providers. Slack built in, I think Anthropic, they got Anthropic built in like very early. So if there is a sufficiently new product that somebody creates, which can do the classic, innovator's dilemma style, like disruption of Slack through a better paradigm, I, I buy that. But I don't think that is, I don't think operational efficiency is the way you unseat Slack. I think it's like, it has to be proper innovation because like Slack can do operational efficiency relatively fast and relatively easy. What they can't do is like maybe kill their product by doing something completely random and different, which is where a larger part of the success exists. I still like, I look once in a while at how Teams beat Slack, the chart, and it is extraordinary. I mean, it happens through the pandemic, right? You can kind of see Slack going like this and like Teams just cuts across and like it's vertical because you have direct inroads into all of these large companies. You can basically say like, hey, A, it's bundled in, B, it's highly secure. You don't need to worry about any of your data, blah, blah, blah stuff. Like, and it links with your calendar. It automatically like single sign sending meeting invite. It's equivalent to Zoom being built in. It just like destroyed everybody because it was Microsoft, right? I mean, there are companies I know who kind of built the exact same functionality who don't get anywhere because like for them to get the first sort of, I don't know, forget a billion, like million users would have required them to spend like an insane sum of money. And nobody would give that to them when there exists large incumbents who can kind of do the same, it's an interesting competitive dynamic today. That's for sure. Like the larger companies have this cudgel that they can win with, which means like you got to be a cleverer to play the smaller company game.
Yeah, I mean the Teams and Slack graph is so startling because like if it was like Discord or something, right? You could like
Yeah.
you'd see like, oh, I've seen that movie before, but it was a
Yeah.
little bit weird to see like, oh wait, the incumbents actually can just do this now. That wasn't maybe as true in like 2010 or 20 years ago.
I don't know. Like it is probably the closest I have seen sort of to like explicit incumbents out innovating somebody that came before and out innovating them in all of the same things they did, right? Like easy to use, et cetera, as opposed to just like shoving it down the throat. I can't think of a good example. Maybe Internet Explorer and Netscape, although like I was too young to understand what that was like. Like I wasn't working and stuff in those days. So I don't know. I can't think of a close enough analogy of like when there existed an innovative company and then you basically came alongside of it and just demolished them as an incumbent. I can't think of one that has existed. I'm sure there is one and somebody will remind me, but like it's pretty historic.
Let's talk a little bit about curiosity. This is one of my favorite like themes that kind of runs through your blog. So your argument that you've made a few times is that basically the best way to increase the speed of progress is to let more people focus on doing things that they personally think are important rather than having these things sort of be centrally controlled and somebody kind of tell you where you should spend your efforts.
Mm-hmm.
Do you think the median person today is more or less curious than they were 50 years ago?
I definitely think they're more curious than they were 50 years ago.
The median?
However, yeah. However, I'll qualify that in a minute, but like it's incredibly hard to measure and there's all sorts of interdependency. So like, let's leave all of that aside and like talk about the vibes, right? I mean, because we're talking about vibes because nobody's done a longitudinal study of curiosity data. But if you think about 50 years ago, which, unknowingly is after we went to the moon, is like whatever, 1973. If you think about the world that existed then, it was far more balkanized, right? The average rate of education was lower. The average rate of interconnectivity is lower. Labor mobility was arguably higher if you were at a certain tier, but mostly was much lower. Average level of wealth was lower. GDP was much lower. Larger companies were much smaller. Like it was a more violent place across almost all dimensions and across almost all of the countries who didn't really have progress. Poverty levels were staggeringly high. I mean, this was before China brought 600 million people out of poverty, or like India and liberalized. It was very socialist in its hold. It was the kind of Vietnam War-ish period in the US. I mean, each part of this is obviously dependent. And if you said like 60 years or like 40 years, this would change a little bit. But any of that era compared to today, when we are like hyper connected, you just know so much more, so much faster if you wanted to, or even if you don't want to, you're just exposed to everything, right? Today, in a way that would have seemed unimaginable to a person sort of half a century ago or more. To me, like what that suggests is that there is a certain level of curiosity that people probably can have that they would just not have had access to in the previous days. The flip side of the argument would be something like, just like it's easier because you get more information, you're exposed to more, you can actually be more curious about stuff that like literally does not affect you or could not affect you ever. You can get lost in those traps, right? You could get caught in political battles and spend all your time on it. And as a consequence, you don't ever spend enough time trying to be curious about the things that are important to you or your life or your career or whatever it might be. So I think like in general, curiosity is probably much easier, much higher today than it was then because like I remember my parents' generation, I mean, life was on rails, right? I mean, it's like it's not like a road network. It was rails. Like you knew what you were going to do for the most part for the longest period of time. And like today, nobody knows what they're going to do like a year from now, as opposed to sort of something much grander. Nobody has grand plans. It's very hard. There's information overload. I think what we probably lack today is directed curiosity. It's very hard to direct it towards something that you think is interesting and where you want to spend your effort because you're a little bit like a kid in a candy store where too many choices and you don't really know what to do, right? I mean, you can theoretically be curious about so many things that like, if you think about the modern malaise in some ways, I feel part of it is like a paradox of choice, right? I mean, you kind of, you can do anything, which is great, but then like, you got to find some way to narrow that down so that you can make a choice and not at each point question that choice. Like, oh, should I have done that? Should I have done that? Should I learn coding? Should I learn AI? Should I go riding? Should I go backpacking across Thailand? Like the number of, should I go to an MBA, go to back, like the number of choices that exist are just too many at any given point to kind of condense it down into a small enough number of variables where you can make some kind of a judgment call or decision, or even to like let that directedness free without being unfettered by all of the like random junk that generally surrounds us, whether it's in the infosphere or generally in us because we are exposed to it. I mean, if you think about one of the modern interesting trends is about like cutting media. Like, oh yeah, I don't read news is kind of common amongst most people I know at this point.
Yeah.
Which is a weird reaction if you think about it, because these are hyper curious individuals who, if they existed, 50 years ago, would have read every scrap of every newspaper that came to their house every single day. But the reason they could do that then and not now is because there's just too many. So it's easier to cut it all out rather than to like restrict into one or two things, right? Like, I think it's a nuanced question, but I feel like curiosity is much higher. Directed curiosity is much harder. I think that would be my consensus.
So it's kind of interesting too. Like, I wonder in a world where people like don't know what to be curious about, and where people can sort of choose whatever it is they want to do. Like, would you expect to see firms figure this out basically? And you could actually argue that some of them have. So something like crypto, like it's super intellectually interesting, and it seemed like it kind of brute forced its way to get all this talent into the industry. And that was like probably actually one of the reasons that to be bullish on the industry was literally because it was getting so much talent. Yeah. And it seems like a big part of it was just because it had like, it had like a political philosophy, it had a technology problem that it was solving that was really big and it was really interesting. So like, would you expect maybe industries that are traditionally more boring, like, Matt Levine to do marketing for investment banking to teach people how exciting and like philosophical it is or something? Could you see that?
It's a really good question. I don't know, but it's a really good question because like the pro argument for that is something like, there is an enormous like deep-seated want for authenticity in the people that you speak to. And somebody like a Matt Levine writing about investment banking is highly authentic. And it is a little bit of a persona perhaps, but like I've heard Matt and like, it's pretty authentic, right? Like, and as a consequence, you feel like, I don't know if it's trust is the right word, but you trust that he trusts what he's saying, as opposed to like, it's one level removed trust as opposed to sort of two levels removed, which is good. The problem is a little bit that like, there is so much of this type of information that exists out there that Matt Levine's credibility goes down the instant he kind of does that. Because his whole thing is that he's a neutral arbiter and saying things that he likes, as opposed to sort of has an agenda of any sort, explicit or implicit. So in other words, the problem is not that the marketing today that informs, attracts, or like compels people to go do something is not good enough. The problem is that there is just too much of it. And as a consequence, you check out of the marketing altogether and go to sort of different sources to get what you actually would want to do. So in that sort of a scenario, I almost think of like, could somebody who displays or tells you ways to use your curiosity, would that be a compelling advantage? I think individually, demonstrably, yes. Like the world has always wanted self-help gurus and we have never had more of them than we have today. On the other hand, like, are there ways by which you can use some of those advantages from an institutional context to capture talent? I don't know. I feel like we are kind of peaking there. I think crypto might have peaked it, right? Because like for a while, finance and consulting used to be say like, oh, come here if you want to change the world. Then tech started saying that. And like they co-opted the language of doing extraordinary, crazy things in the world and like, building the future and all of that sort of stuff before like asking you to code like a SaaS app or something. And like then crypto came along and blew it all out of the water by saying like, we're going to change the entire world. It turns out it was like filled with Ponzi's. So I think we're kind of going back a notch to kind of ratcheting down and saying like, all right, forget about the marketing for a bit. Institutions are institutions. They're profit-driven like organizations. We're trying to go build something. Yeah, we'll change the world, but like we're here to make money. I feel like there's a little bit of there's a return of realism in some ways where the rhetoric kind of is starting to get ratcheted down, as opposed to sort of the other way of saying like, let's take some of these interesting social nuances that exist and like use them to kind of compel people to come and join us. I don't know about you, but like when I read kind of startup like pitches of why you should work here, etc., they've started to become a lot more simpler. This is what we do. It's an interesting problem. Come and join. As opposed to like, I remember like even, Salesforce pitches from 3-4 years ago of like wanting to hire engineers. It's like, it's all like so hyperbolic. It was like a pastiche of itself. You could not read it and not, I don't know, like I couldn't read it and not laugh, right? I mean, it's a self-conscious kind of thing. It's like, do you guys not see what you're putting on paper? I mean, Silicon Valley went from being like a complete parody to uncomfortably close to reality. Like it's like hairs with different to what actually happens in the world. And at that point, you can't push that any further. You have to retreat a little bit into realism and maybe let some of that undirected curiosity kind of bubble up automatically. I feel like I'm kind of talking to myself a little bit here, but it is an interesting question. I don't have a
Yeah,
strong answer.
I guess the other thing about it too is maybe it's like the stuff that comes actually from real companies is like kind of lame. And, someone who's just curious, like a high school or something, is probably not going to go read the Salesforce pitch, but you might read like Vitalik Buterin's blog, right? And he's got
Yes.
like a super interesting post that he puts on there. And
Yeah.
like, they're not like explicitly about like marketing Ethereum.
Yeah.
They're more just like very philosophically, like, here's what I'm thinking
Yeah.
about today. And with like something like banking, there actually there's probably only one I've ever seen in my life besides like Matt Levine. There was like,
Yeah.
I think he's called like the Epicurean deal maker or something, some anonymous banker, like
Right.
many years ago, but actually like really interesting like stories
Right.
from like his career. And it feels like there actually could like, if there was a way for them to get more of that out there, you might be able to catch some of these people earlier and be like, oh, this is actually a really interesting industry. And to your point about it peaking at crypto, I guess the only other argument I would make is like AI seems to be doing actually a really good job of it right now. Like the Yudkowsky arguments, like less wrong is probably the best marketing of all time. So maybe it's not like the firms actually doing the marketing, but there's maybe something more like that you could do outside of your direct firm to sort of promote the industry more broadly.
I think it's fair. I think the only two things that I would comment here is that like all of those examples that you mentioned are, I mean, a firm spends money on marketing because either it helps them from a brand perspective or like from a direct marketing perspective in some way, shape, or form. None of these things, you can't bank on it helping. So can I see a world whereby firms kind of throw out grants, for lack of a better word, to individuals and say like, write about what you want because roughly you seem aligned with what we want to do. Like, yeah, I mean, I see that kind of happening. Will that substantially change the status quo? I'm unsure, but I'd be very curious to see where this plays out. I mean, with AI today, which is the second point, I think it's an interesting one because in a weird way, I almost think of like two layers. On the one layer, there were some people who were influenced by like Less Wrong or whatever and kind of went into AI and started actually doing work and research on it rather than sort of write online and kind of did cool stuff and like developed GPT and all of those sort of good stuff, who were very much from the academic tradition, right? I mean, they predate the existence of AI, as existed in the Yudkowsky debates, etc. And the second part is like an enormous cottage industry of like organizations who study like whatever, different parts of this from different angles, who I feel have not contributed anything meaningful to the debate so far at all, except for adding a lot of bodies to it, which is nice. But then bodies would probably have been added anyway from like once GPT-4 launched or like ChatGPT launched, it was inevitable that there would be an avalanche of people who would get interested from purely market dynamics. So I find it difficult to kind of extricate both of those things from each other. In fact, in many ways, like folks who have been writing about AI on like places like Less Wrong for years are at a massive disadvantage because they had this world model of how it actually should look and will look that turned out to be not true at all, which is causing more whiplash than like people who kind of came in de novo and be like, hey, that's super cool. Let's kind of work on it. So it's like, I don't know where I net out on this. I feel on the one hand, yeah, it's always useful and interesting to have good perspectives out there. And there has never been a better time for an individual to create a name for themselves without the benefit of an organization. Now, can organizations split that and use the individuals to benefit themselves? Possibly, but like, I'm not entirely clear on what the causal link there looks like, if that makes sense.
Yeah. I wanted to talk a little bit about your interest in networks. And this actually kind of relates to the previous question because Zoom seems to be doing some like anti-marketing for their industry. Right. They recently announced a return to office policy, right?
Oh, yes.
Which is a little bit different than what we were just talking about, which is to get everyone hyped up about your industry. You write a lot about the importance of linking smart people together. And it seems like a lot of companies, right, are trying to do the return to office thing. Do you think this is just outside pressure or are people just giving up on sort of the idea that there are new different ways to collaborate across geographies and cultures and the whole rest of it?
I think a large part of it is that the managerial class, if I can call it, are far more comfortable with the previous status quo than anything else. And I have looked to find good empirical data on if people not working together has had any negative impacts, and I have not found any. Like, I've been looking because, like, my thesis was that we had almost like the perfect economist dream, right? Like a 2 to 3 year firm exogenous shock event that forced everybody to change their working behaviors. And then a staggered return to normal across different countries, different firms, etc. So I was like, surely, people who are insisting that people should come back to office will have data to back it up. I don't know what data, but like something must exist, right? Like product ship late or quality lower or QA benefits or QA arguments are sort of getting higher. We need to spend more efforts, or like customer complaints are increasing. Like there must be something across the extremely high dimensional world that is business where it makes sense for people to force others to come into work. I haven't found any. What I have found is like a lot of feelings and vibes about what is actually important for communication, collaboration, and like deep work. And I'm not saying like vibes are not important. I'm saying surely they're insufficient if this is kind of the focus, right? I mean, if you're this intransigent about like your belief, then you should be able to back it up with some data from at least the last 3-4 years, right? I mean, something. I know there is a couple of half-hearted academic papers. Microsoft published one like 2 years ago or 1.5 years ago that showed it was actually better in some ways, even though spend more time in meetings. There is nothing that shows like a dramatic, proper reduction in efficacy of remote work. And that said, now when I look at companies compelling people to come back, a lot of it is just because like, I think you have this and you have people and you have this feeling like if they're not in front of you, they're slacking off or whatever. And therefore you want to compel them to work, come inside as a countervailing force. The question to me is almost like, if they are slacking off and getting all of their work done in 2 hours and like wandering around and like taking calls or whatever, they must have been slacking off like this before also. Because it's not like, if everybody suddenly stopped working sort of 60%, then something must drop 60%, right? Where's the effect? And if they're in the office and it hasn't happened and all you can talk about are intangible potential collaboration opportunities that might have created new revenue opportunities in the future, again, we are 3 years in. And we've seen some rather remarkable innovations come out of all sorts of companies under all sorts of conditions. So I put most of this move in terms of like managerial vibe-based decision making, as opposed to sort of anything real, with the additional point that like a large number of companies treated remote work as like normal work with Zoom, which is, I think that it's okay, but like, I'm not entirely sure they ever kind of thought about what people were doing in any meaningful sense in the first place. Because if you're working remotely, you do need a little bit different cadences, right? You need different check-in, check-outs, or like you need different expectation settings, or you need different meeting structures. You can't do that as much if you're on remote. But like the solution there is not to say it doesn't work, bring them all back. But the solution is to like think maybe a little bit about why is it not working and can we actually change it? So a bit of a nuanced answer, I suppose, but more broadly on the lines that like I'm majorly I'm pro remote.
Yeah. That's interesting. You wrote a post that was featured in the Diff recently that kind of does a deep dive on what exactly the mechanics of VC are and how they've changed. They've changed over the last few years. So question for you is like, with some of these like super mega funds that moved way up market to later rounds, like Tiger, SoftBank, getting kind of crushed over the last couple of years, do you expect to see sort of a shift back down market and people to, quote, stay in their lane more? Or do you think that this model is here to stay?
It's already happened, I think, to some extent. There are lesser, the trend to get bigger has reduced. The pressure going smaller is always harder because your management fees take a hit. So I think that's going to be a slower time coming, especially in an industry that moves as slow as we see. But you do see, what you will see is that the net AUM will perhaps take a bit of a negative hit just because like there will be a bunch of funds that die. They're sort of natural deaths. I think there will be the interesting thing about, when I wrote that post for Burn, like one of the conclusions surprised me a little bit. So like I've been thinking about it since, which is that one thing we did over the last 10 years was to kind of industrialize a certain model of entrepreneurship. Like given the obvious idiocies of many investments that were done at that time, negative margin businesses that made up in volume. Despite that, I feel like there is a model now of like, what each investor does and how do you go from one stage to the next. And people have playbooks of how do you scale and like how do you hire and all of these kinds of things that were fairly artisanal before. And as a consequence, I feel there is a specific role that a lot of these investors are known to play. Like, yeah, I do $200 million checks into this type of companies, and these are the metrics I look at, and then I can help them expand into a market or whatever. Those skills are valuable. They continue to be valuable. They used to be mainly skills that existed disaggregated in the previous markets because like companies would go public and then hire like advisors to fulfill those things. But now you can be an investor and do it, which is even better because you get paid in equity instead of cash, and like they can be valuable later on. So I think those skill sets definitely exist and will continue to exist. I don't think the IPO valuation is necessarily going to go much lower. Like you're not going to see, Google style $200 million IPOs. You're still going to see like large, mega, multi-billion dollar IPOs just because that's become the new normal. And there's if that needs to happen, you need to have funds who are able to write like $200-300 million checks. If you have a fund that's able to write $200-300 million checks, they need to be a multi-billion dollar fund. Do they need to be 100 billion like SoftBank? No. But arguably, SoftBank did that as like a mini BlackRock as opposed to sort of, it did it as a mega Sequoia, if that makes sense, right? I mean, they were playing a different role in the ecosystem. So I do see roles continuing to evolve for these funds. I think the mega funds will exist. They will have to play different roles because you can't invest in a $10 billion company and underwrite a $40 billion exit just sort of as normal. You will have to work for your money. Everything gets compressed. You will have to invest in like a $5 billion company and get like pref stacks and sort of tag the exit bars or like get dividend payouts or force different forms of compensation so that you hit your IRR thresholds. But arguably that's a good thing because more efficiency in the market is good. More companies going into the public markets at slightly lower valuations is good for us as retail investors because like you get to actually buy into these things at sort of some clip. Something I did not write there is that I expect secondary marketplaces to perhaps become even more organized and perhaps more common for employees as well as for consumers. Consumers, because like we said, you want to get a piece of that pie. Employees, because I know an uncomfortable number of people now who have had underwater options that they pay tax on, which is a terrible place to be. So the market will kind of correct it with sort of the funds becoming part of, I don't know, it's a new escalator, right? I mean, you kind of go from one to the other in a fairly smooth fashion and everybody knows what to expect.
Why hasn't the secondary thing taken off really yet? And there's a bunch of startups out there that are doing it. But it doesn't seem to me like I've heard of any of them really, any specific one becoming like really large or super successful yet.
It is a more complex deal. That's the main reason. Because private companies have ROFR rights, right of first refusal, which kind of can block some of these transactions. Many of the sales that happen are by different parties whose stocks have different rights, unlike in the public markets. So you'll have whatever common from employees or like options. Sometimes like some of these guys get it structured or like different pref stack if one of those investors are selling, etc. And all of these things together mean that you have a highly illiquid market, which also means like it is almost entirely populated by brokers who effectively end up like calling people and saying, oh, you've been at Stripe for 4 years. Like, do you want to sell some? Which is kind of the normal way these things get surfaced. There are a couple of exchange-ish things that are trying to make it slightly more structured, like NASDAQ has one. For later stage companies, Carter kind of has created it, but like nothing really has captured that enough demand volume for this to just become normal. Carta arguably has an advantage here because all of your cap table information is already on the thing, which means you can run sort of a regular auctions, which was what I think Pipe was doing. And a few other companies have started saying that that's what they will do, because they'll be like, all right, every year, take a pool, run it as an auction. There's a clearing price and you can sell it. That creates a liquidity event on both sides, which makes it slightly sensible because you can at least mark to market on those prices. And if you're a startup, honestly, the fact that sales don't happen is good for you, right? Because like people sell for all sorts of reasons, but if there's a lot of sales, if there's high volume, that is bad for you. Because this is not a stock that is publicly traded, which means the only way sales can happen is people who are incentivized to hold it, like employees or shareholders, are saying, I want to get cash today instead. And what if they set a price that you don't like? I mean, today, if Stripe transactions happen for like whatever 60 billion and their last public valuation was 92, they can say like, who cares? It's like a 10 million block sold by an early employee because they wanted to buy a house in Palo Alto or something. It's like, there's an explanation. Nobody really cares. If it becomes more common, then like the price is the price. The next time they need to go raise capital, like you're going to have to justify not your prior valuation and growth thereafter. You're going to have to justify the price, which is a much harder thing to do because like to their credit, markets are irrational. But on the other hand, the markets are the market. So you're going to have to kind of play off both of those things against each other.
Yeah, you're creating a market where maybe the company wouldn't necessarily actually want one at that point in time.
Yeah, because they want to control their narrative and their story and their price rather than kind of give that control over to someone else, right? Because like when they go to the next round, they'll be like, hey, we were valued at X. We grew whatever, 50%, 100% from there. We think our current fair valuation is Y. And then there's a small pool of buyers and there's like one seller. And then you can kind of negotiate with each other and find a market clearing price. But if the pool of sellers increases and the pool of buyers increases, all of a sudden, like you don't have control over that narrative anymore. You can't go to somebody and say like, you should give me whatever 150 billion valuation, even though like our market sort of clearing shares are being traded at like 50 billion valuation. Because like they would rightly ask like, why would we do that? And if there's sufficient volume, that question becomes even more important.
So here's like just an old school retail personal finance question for you. So if you walked over to a bank and you say, I want, 5x leverage and I want to buy a house, the bank will run a credit check and then they'll give you the 5x leverage and then you'll buy a house. If you walked in the bank and you said, I want 5x leverage, I'm going to keep it in VTI or pick your index fund for 30 years, they're going to say, get out of here and you're on a blacklist or something, for being a risky client. So why is that? Like, is there some threshold where it would actually be smart for more retail investors to just trade on margin and take out like 2-3x leverage? Or is that just a bad idea in general?
It's a bad idea in general. But the reason it works for houses is because houses are bought and sold very rarely. As a consequence, you can actually bank on the value with some certainty over longish periods of time, much more so than almost any other index you can think of. Because if you think about any other index, right, like whatever, even take a stable index, forget index, take Berkshire. They only own like stable companies. Even for them, their ability to get value, say a year from now, is dependent on all of their underlying companies performing in a certain fashion a year from now, which is dependable, but it is less dependable than whether you and I will be living in a house a year from now, right? Like that's it. One of these is clear, one is less clear, which means like getting loans to kind of purchase an asset or rather asset-backed loans is much easier for some types of assets versus others. But you want to do the same thing in a bank? Here's what you do. You go into a bank and say, I have $100 million. I will need you to give me $400 million to go and buy that factory. They'll do that for you. Because at that point, that asset has, sufficient earning potential, which you can demonstrate that you can pay the interest and have sufficient coverage afterwards. So one way to think about it is like you buying a house is as close as it gets to you doing a buyout transaction, as opposed to it being a really shitty version of you doing a leverage purchase of S&P because it sits at a different spectrum, right? Like, I mean, buying a house is one of the few ways where an individual investor can act like Vista private equity. Like you get enormous debt thrown at you, like much more than sort of what you can get under any reasonable circumstances, for you to go purchase an asset with the assumption that like, hey, in 5 years, even if the value has appreciated zero, you can still exit it, pay off the loan, and have a bit of cash in your pocket, which is unusual for that characteristic exists for very, very, very few companies in the world. And it exists a little bit for some types of private, even PE, they have to operationally improve companies these days because they have to improve the margin by, the reason PE makes so much money is because of leverage, right? I mean, they can improve the margin by like 10 bips and suddenly like the value increases a lot more because most of it is leverage, which means as long as you can cover the interest, everything else works out in your favor. So there is logic there, but it's just that at the dollar values that you would be able to invest in, a house is is closer to the end of like a private equity transaction that you're actually able to do where you can buy out an existing asset as opposed to sort of anything else where you get a loan to kind of go up and do stuff. I mean, that said, like even small business SBA loans kind of give you 70-80% of a business value, right? I mean, if you find a sufficiently cash flowing business, I've heard they do. I haven't looked into it too deeply, but
I wonder, like, if you just looked over any 30-year time period, would you expect the VTI to be on average a person's home on returns, or like, the small business factory that someone's starting?
I don't know. I don't know. I've allowed to run the numbers to kind of tell you, but like the volatility during the path that matters a hell of a lot during this process, right? Like,
that's what I was kind of getting. That's what I was getting at. It's like, is the mark to market is like the thing that kills you?
But it is. Yeah. So like, like I said when I started, it's like housing is not one where there's no number there's a number to this house. It doesn't matter, but because like it's not being sold. If it was being sold, the number matters. So like any realtor shows you, they're like, oh, there are 4 houses that sold in this vicinity, and this is the kind of number. And you kind of go like, on the one hand, 4 houses, wow, I mean, that's sort of relatively accurate. On the other hand, like 4 data points for like a sale of an asset, it barely matters, right? I mean, we're all kind of making this out. It's like, oh yeah, no, it has a backyard, so it's nice, and it doesn't, there's shadow. So the fact is, like, if you do not need to mark something to market, then of course, like, it helps because it helps across everything, right? I mean, arguably the largest leverage play was the Vision Fund, who took 60% debt on a $100 billion position to buy into venture capital. They still worked out okay. I think they managed to at least pay off the interest because like the companies they bought, they were able to get enough dividends and enough sales that it kind of made up for some of it. But mark to market has kind of, I think Masa's got a pretty thick skin, but he got rattled several times because of the NTM issues. So like, I don't know. This is one of the best things about public versus private markets. In public markets, you do get a number. Like, I'll give you an example, right? Like I did one of the pre-IPO investments I made was in Asana, and I love the company. I still hold some of the stock, but it's like it shot up 5x after sort of it IPO'd, and we sold most of it, and then it came down to like below the IPO price. And like throughout this, I had conversation with like sort of other partners. It's like, oh yeah, why is it at this price? And there's no answer to it. Like, it is at this price. What do you want to, like, I mean, the price is the price. In private markets, you can ask, why is it at this price? And then somebody would tell you, oh, it was at 20x before, but the forward projections fell, or like the CEO got let go, like whatever. There's an answer that you can look at and go, oh, that causally explains why this happened. In public markets, sometimes the price is the price. I mean, like Ben Graham wrote like a decade or like a century ago, well, like market's crazy.
Yeah, it's kind of counterintuitive, right? Because you think there's like a liquidity premium on things, but I think actually Cliff Asness has like an article on this called the illiquidity premium. Like he makes the argument because he's in public markets that he's like, wait, there's like all these advantages to being private.
It was just
you could do things like this. Yeah.
All of these companies like Adyen was trading lower than Stripe because Stripe had a liquidity premium not that long. Tiger who had a public and a private portfolio running roughly the same playbook. The public portfolio fell like 70% or something, and the private portfolio was marked at like flat. Because because it is like, you can argue they should also mark it down, but like by how much is an incredibly hard question, because markets exist because with sufficient numbers of buyers and sellers, you can collectively end at a price. What do you do when you don't have sufficient number of buyer and seller? You can't just like make one up.
All right. So we'll do the last question here. What's your view on VC value add for startups? If you take like the YC and Andreessen Horowitz model, where it's like, we're going to help you out and incubate you and we're a team for you. Or you take the founders fund model, which is all you need is a brilliant founder and cash. Where do you fit on that spectrum on your beliefs?
I think individuals can help startups in potentially life-changing, but mostly tangential ways that are definitely useful, but not life-changing for a startup's trajectory. But I fall mostly in the founder side of, given that spectrum, I fall mostly on that side. Because like, what VCs can actually help with is like introducing to other VCs, people, customers, etc., in order to raise funds or like raise revenues. Sometimes landing a senior exec or like help with hiring, etc. But the way I look at it is like, if you didn't take money from the VC, could they do the exact same thing fairly easily? And the answer almost always like, yeah, because it's emailing someone, right? I mean, you ask me, I'll email someone. Like, this is not a high effort activity. Like, there are people who go above and beyond. Like Ron Conway has this legendary reputation for like doing a lot of legwork and going and helping, etc. And while that does happen, that is not the norm. So in fact, like when I sort of advise startups, I almost always say like, they can help you in some specific things, but you should not count on them helping you to kind of win your startup race, because that's putting the wrong, like that's way wrong of an expectation. And I know some VCs like to put that expectation forward, even though that's wrong. I mean, that said, one of the companies that I used to be in the board of that we sold, like it took me and the chairman about 9 months of hell to kind of make that happen. And we did it. I don't know. It's one of those situations where like the management team should have been incentivized to do it properly, but they were not doing it. And we had to step in and do it. But it's also like a very individual thing, because like, I know, I'm like really close friends with George now, who's a chairman, was like, there's no reason for us to have to do it. It comes down to the individual, right? As opposed to sort of you're invested in it, therefore you kind of are expected to step in and do all of that sort of stuff. Maybe, I don't know, slightly nuanced, but I'm closer to the founders model, where I don't think it's fair to expect capital to pull their weight in terms of actually running the company. That's on you. It's for the better. Let me put it that way.
Well, Rohit, you've been super gracious with your time. This is a lot of fun. Thank you for coming on the show.
Oh, my pleasure, man. Thanks for having me.